Many years ago, making investments was almost exclusively for wealthy individuals. This was because to invest your money in the stock market, you had to do it through a stockbroker, also called a broker, which is a company authorized to buy and sell stocks on the exchange. A broker works as follows. Suppose you want to buy a share of Apple. You cannot go to the stock exchange and buy that share directly because you are not authorized to do so. That's why you have to give your money to a broker and ask them to use your money to buy that Apple share for you. In exchange for this service, the broker will charge you a commission for each transaction you make, such as when you buy or sell a stock. However, the commissions charged by these brokers were very high in the past, and they even set a minimum amount for each transaction. For example, a broker might charge you 2% of the transaction, but the minimum commission to pay was $50. If you were buying $10,000 worth of stocks, you would pay a 2% commission, which is $200. But if you could only buy $100 worth of stocks, the 2% would be $2. The broker would still charge you the minimum of $50, representing 50% of your money. This made it expensive for small investors to participate in the stock market. The fees charged by brokers were high because everything was done manually. The sale of stocks involved a person talking on the phone with a broker's employee who took the order and then sent it to another employee to complete the process. This manual process required many people, as depicted in movies like The Wolf of Wall Street, where we see an office full of people calling investors to sell stocks. However, technology later intervened, automating most transactions. Today, you can simply log into an online platform, buy the stock you want, and the system processes everything without human intervention. This significantly reduced the costs for these stock trading companies, and commissions are now very low, often less than 1%, and in most cases, without a minimum. Now that it is easy and inexpensive to buy and sell stocks, many retail investors, individuals who are not investment professionals, start investing in the stock market with the hope of getting rich by investing their savings without paying high commissions. However, some time ago, brokers started emerging that stopped charging commissions directly. This means you can invest without incurring any expenses, making investments more like a fun video game than a serious job. An example of this is Robinhood, a broker that operates through its app, designed for people who know nothing about investments. It tells you that investing doesn't have to be so difficult and allows you to start investing with just $1. But if they don't charge commissions, how do these companies make money? In today's video, we will show you the business behind these commission-free brokers and how they use inexperienced individuals like you to turn their business into a multi-billion-dollar enterprise. Despite the differences between the previous model, where high costs were charged for buying and selling stocks, and the current one, where it is often free, the key lies in the broker's business, which is to generate many transactions. In other words, they need many clients buying and selling stocks through their platform. Not charging commissions for transactions is a great strategy to attract clients, especially those who may not have much money to invest, as we saw earlier. However, not charging commissions doesn't mean that these companies are charitable organizations. In fact, the major commission-free broker platforms are companies, meaning they have found other ways to extract money from their clients. What is that way? Let's see how Robinhood's business works as an example. Suppose you want to buy a share of Apple. If you buy the stock through a traditional broker, basically what you do is instruct the broker to buy that stock for you. The broker buys it instantly on the stock exchange and delivers the stock to you. However, in the case of Robinhood and other commission-free brokers, when you ask them to buy a stock, the broker doesn't buy it instantly on the stock exchange. Instead, it sends an order to a high-frequency trading (HFT) firm. These are large companies that invest money, but instead of using people to analyze investments, they use computers. These firms use advanced computers to search for news about companies and analyze their stock prices, allowing them to make buy and sell decisions thousands of times faster than a person. So while a person needs time to analyze news and then make a stock purchase, the computer takes milliseconds. How does it benefit Robinhood to send the order to an HFT firm? Stock prices vary depending on whether people are buying or selling those stocks. If many people buy a stock simultaneously, the price goes up. And if many people sell that stock simultaneously, the price goes down. If you knew that thousands of people were about to buy a stock, you could buy it first and make money when the stock price rises. This is precisely what HFT firms do with Robinhood. Let's look at an example. Suppose you want to buy a share of Disney and you instruct Robinhood to buy it for you. Robinhood will save that order and combine it with thousands of orders from other clients who also want to buy Disney stocks. It will then give all those orders to an HFT firm. Now that the HFT firm knows that the price of Disney stock is about to rise, it first buys stocks for itself. When the stock price goes up, it executes the orders of Robinhood's clients, making money from the price increase. Of course, all this happens in seconds and with fractions of cents. In each transaction, the difference is less than a cent. However, if millions of transactions are made with fractions of cents, a lot of money can be made. Since Robinhood makes money for these HFT companies, the HFT firms pay a significant amount to Robinhood. This is why they don't charge you commissions. Not charging commissions is part of the strategy to attract more clients and generate more buying and selling transactions. The more transactions clients make on a stock, the larger the number of orders Robinhood can sell to HFT firms. If the number of orders is higher, the price will move even more because there will be more simultaneous buying or selling orders. This generates more money for the HFT firms because the more the price moves, the more money they make, and they will pay more money to Robinhood. For this reason, Robinhood and similar companies try to turn investments into something simple and more like a game. This makes people think that making money is easy, encouraging more and more people to invest through Robinhood. Now, how could the fact that Robinhood buys the stocks you requested through an HFT firm potentially harm you? The main problem is that as the transaction takes a few seconds to complete, you probably won't end up buying the stock at the price it was when you ordered Robinhood to buy it. The difference will only be in cents. But if you are one of those investors who buy and sell stocks all the time, several times a day, those cents could represent a lot of money after multiple transactions. For example, if you buy and sell shares many times a day, and in each transaction you make 2 or 3 cents, losing half a cent would be between 15% and 25% less profit. On the other hand, if you simply want to buy shares to hold them for a while or sell them in a few days, a few cents won't be significant, and it won't harm you at all. This business model, even though it is convenient for some small investors since they don't have to pay commissions, generated a lot of controversy. This is because Robinhood, for example, is essentially selling information about the buy or sell orders of its customers to a few investment firms that use that information to make money, knowing in advance how the price of a stock could move. Some think that this could be a case of insider trading, an illegal practice. Insider trading occurs when a person buys or sells a stock, having information that others in the market don't have. Let's see this with an example. Suppose you are friends with an employee of Disney, and that employee secretly tells you that the company is going to announce significant profits in the last year. Knowing this, you could go and buy a share of Disney today, as it is likely that tomorrow, when the company announces its profits, many people will buy and the price will go up. But buying a Disney stock to benefit from that information would be illegal since you have information that other people in the market don't have, giving you an advantage. In fact, in 2020, Robinhood faced an investigation by the SEC, the US government agency that regulates and controls the stock market, regarding its agreements with high-frequency trading (HFT) companies. A few months later, the investigation concluded, and it could not be proven that there was insider trading. Robinhood did not sell information about a specific company to gain an advantage as seen in the example, but it only sold information about its clients' orders. However, the company paid a $65 million fine to the SEC for misleading its clients by not telling them that it was executing their stock orders through high-frequency trading firms instead of directly on the stock exchange. Beyond the debate about whether selling orders to high-frequency trading firms is good because it allows clients not to pay commissions, or if it is a way to make more money benefiting large companies, the truth is that the more transactions people make, the more money these brokers will earn. That's why they are free. So the best way to get people to use these platforms is by telling them that they will make a lot of money. These companies don't just offer buying and selling of stocks, they also offer other types of investments with which you can make much more money. An example is options. An option is an investment that works like a bet. When you buy an option, you're essentially buying the right to buy a stock at a fixed price in the future. For example, you could invest in an option to buy a share of Apple at $200 in 3 months. So, if in 3 months the stock price is above $200, let's say $300, you will make money because you can buy something worth $300 for $200. However, if the stock price is $100, you will lose money because you bought something for $200 that is worth $100. Even if the price drops significantly, you could lose all your money. But how much more money can you make? The average annual return you would get if you invest in the S&P 500, which is an index that averages the stock prices of the 500 largest companies on Wall Street, is 11.88%. This means that if you wanted to double your money, you would have to wait about 7 or 8 years. However, for many people, especially non-professional investors dreaming of getting rich quickly, this is not good enough. That's why they turn to much riskier investments like options, which have the possibility of doubling your money in just one day. The 8 years it would take to double your money by investing in the S&P 500 is not attractive for many people. As Rodrigo Garcia, CEO and founder of Sirota, a significant online broker, mentioned, 80% of options end each day in losses. Buying options ruins most retail investors, but if people knew how risky options are, probably many of them would choose not to invest in them. Instead, brokers have started promoting options, telling people that they can get rich and making the process of investing in options as simple as touching a button on your cell phone. Everything is set up for you to invest your money, thinking it's easy and making people feel comfortable playing in the markets as they would with a video game. If we look at the options section of the Robinhood page, we'll see how they promote a strategy creator to plan, build, and execute your option strategies, making an investment that is not easy seem easy. They don't mention any of the risks this investment has. To know the risks, you have to click on a small button that says Strategy Creator Disclosures, where you get a window without any design that clarifies that options involve a significant level of risk and are not suitable for all investors. In fact, Robinhood says that everyone should have access to the financial markets, and that's why they created the platform to make investment easy, accessible, and understandable for beginners. Of course, everyone is free to invest or spend their money as they wish, but these companies must clearly show what the risks of an investment are. Otherwise, they are making people think that making money by investing is easy, just to add more clients and make money with high-frequency trading companies. In reality, investing requires training, study, and professionalism. These attempts by brokers to make people believe that investing is like a game are causing thousands of small investors to risk their money, even those who shouldn't. Many clients who invest in these platforms do so with small sums of money because they are people who practically live day by day and dream of getting rich. It's true that if someone wants to invest only $100 in stocks each month, a commission-free broker is the best way to do it because they won't spend much on broker commissions. However, someone who can only invest $100 a month probably shouldn't invest in the stock market. It might be better for these people to save that money as an emergency fund or invest it in their bank, learn a new skill that could generate additional income, or simply paying off a debt. The FICO score is a tool that banks use to measure how good or bad a person's financial situation is before giving them a loan. A 2022 study showed that 43% of Robinhood users have FICO scores below 650. When the score is above 650, it means that the person has a healthy financial situation, and banks will no longer lend to them, knowing they won't be able to repay. The fact that almost half of Robinhood users have a score below 650 shows that many of the people investing there have a lot of debts they can't pay and are in a bad financial situation. These are people who are excited about becoming rich and getting ahead by taking risky investments without the necessary knowledge. But considering that most of them lose money, as we saw earlier, for these people, it would be much better to use that $100 to pay off their debts or to save without risking their money in case something goes wrong and they need it. If we look at the FICO scores of clients of other online brokers that don't present investments as a game, such as the case of Schwab or E-Trade, the percentage of clients with less than 650 points is only 33%. This is because these brokers' platforms are less user-friendly, and one needs to be a professional to use them. Moreover, they often have minimum amounts to operate, such as the case with E-Trade, where you have to deposit a minimum amount ranging from $5,000 to $1 million, depending on the type of investments you want to make. Additionally, the problem with this type of untrained investors is that they often try to make money quickly while getting scared just as quickly if they start losing. This leads them to have profits that are not as good as they could be, since they lose more than they should. Let's look at this with an example. Suppose a person who is not an expert in investments and also needs money buys Apple shares at the point marked as the first entry point. Here, 3 situations could happen. The first is that the person sells after 2 days, making a very small profit and missing out on the price increase that will come later. The second option that could happen is that the person holds onto the stock for a more extended period, and when it starts to fall, sells out of fear of losing more money, also missing the entire rise. The last situation that could happen is that the person sells quickly, and as they see that it continues to rise, buys again at the point marked as the second entry point on the chart, only to sell quickly again upon seeing that they are losing money with the price drop. A non-professional person is unlikely to hold on to their stocks in the long term, and it's most probable that, without having to pay commissions, they buy and sell all the time, generating very small profits, or even slowly losing all their money. A study conducted in 2019 by Dalbar, a company that investigates investor behavior, showed that individual investors average an annual gain of 3.69%, while the S&P 500 averaged an annual gain of 11.1%. This means that if people had simply invested in the S&P 500 without buying and selling stocks on their own all the time, they would have had a gain almost 4 times greater. On the other hand, a study by Larry Swedroe, head of economic and financial studies at Buckingham Strategic, a company that provides financial advice, showed that most people who buy and sell stocks daily on Robinhood lose money. While only 20% make profits, in a typical year, only 1% of them are able to generate more and more gains each time. This means that 99% would be better off if they abandoned the daily buying and selling of stocks. These companies have come to make you believe that investing is a game and that you can get rich quickly, easily, and effortlessly. But the reality is that while many people lose their money every day, companies like Robinhood make millions of dollars using their clients' money to make money, benefiting high-frequency trading companies. Thanks for watching, guys. I hope you enjoyed the video. Please leave a comment. Also, please consider liking and subscribing. I would really appreciate it. Thanks.